All right, so for the balance sheet, we have beginning balances given to us here for all the items, and we'll just carry that forward into the Excel spreadsheet. The total assets, put a box around that so we know it's important. And similar total liabilities, and the total equity, and the total liabilities and equity. Now we say, well, what happened during the month for cash? We have total cash receipts. That's a plus there, 88,000, equals the sum of all those negative numbers we had previously on disbursements right here. And we also had the repayment right there. So those are disbursements. So the balance should be 15 plus that, plus the minus number is 33,520, which matches right there. So right here, 33,520 needs to match here, 33,520. Accounts receivable, we had sales plus the 90, and then we had collections. How much did we collect? We did that in the cash receipts estimates. Right there, cash receipts. And that should be expressed as a negative number. The net is 36,1 plus 90 minus 88, and it's 37,8. The way to check that is that should be the leftovers from the sales in June, 37,800. Let's just check it out. And it's right here. This number matches. Next, we'll look at the inventory. How much did we purchase? We purchased right here, 36,000. Or how much did we have in sale? Right there, 36,000. And so the net is 7920, which should also match the number we had because we solved for that earlier. And it's right there, 7920. That has to match also. Okay, so we're tracking nicely. Then we had equipment. So we didn't purchase any equipment during the month, but we had some depreciation. So how much do we have in depreciation? Let's do minus sign. We had some in selling, right there. And we had some in G&A, right there. That's 4,600. So net position is 90,400. Total assets equals sum, open parens, and 169. Okay, liabilities. Let's start with our purchases, 36,000. Payments were right there. So the net is beginning plus new purchases minus. That should equal the leftovers from our merchandise, 27,540. And it's right here. That was the leftovers of the June purchases that we're going to pay in July. So that's still tracking also. So income taxes, we had 1,550 balance, but we paid that amount. That was the minus that we saw earlier up here in the cash flow. I'll just point to it right there. And we have income taxes accrual, which we just did above right there. It's a minus that number. So the balance should be 15,500 plus this minus that, which should be the same as the ending balance. Accrued expenses, we had beginning of 2840, and these were for those G&A expenses. We had new accruals plus G&A of 8,400, but we have to subtract out the non-cash. And then we have payments made. Payments made in G&A in the month, right there. So the balance is 2920 accrued interest, we have additional accrual this month based on the interest expense. And it's right here. Interest expense is additional accrual. And we had a major payment. We subtracted out the payments, which was due there, 6 months. This balance should be equal to 0. 0 because as of the end of June, we paid up the bank. So we accrue during the year, same monthly amount, 125 times 6, and at the end of June, we pay it all off. Loan payable, we had no draws from the line, but we did have a payment. We reduced our borrowing by $5,000. So let's go pick it up from up here. $5,000. Our balance is $25,000 minus 5, or $20,000. Now we can get our sum. Let's run, open parentheses. So we had total liabilities of $60,608. Common stock, there were no changes. Net income, we did have net income. Right there. And no dividends paid. So balance and the total, 109. And if we add those together, equity plus liabilities, 169,540. So this number, which is total assets, must equal, as you know, that number. Total liabilities and equity. That number is comprised of liabilities and equity. Great. So we're in balance and life is good. Balance sheet balances. Okay. The balance sheet here matches 69,640, what we did on Excel. And again, this shows sources that we did that already. All right, so finally, budget, we have 2 questions. First, is the proposed budget feasible? Can we do it? And is it acceptable? Acceptable to whom? To shareholders, to the board of directors, to senior management. So that finishes Mod 22. And summarizing, budgeting is an essential process for good planning, coordination, and management. And although there are many methods used, the best practices are for direct costs to be budgeted at the unit level. That's called the input-output method. And for overhead, we use activity-based budgeting. And department costs, we use zero-based budgeting. These techniques in combination will lead to the most accurate and most useful budgeting process and results. Then we did one master budget exercise where we looked at a merchandising business and did the 7 steps. First step being the sales process, and then each of the ones detailed for purchases and other expenditures, leading all the way to a cash budget, then income statement and balance sheet. So that's it for Mod 22 on budgeting.